Welcome to the Pro Ticker Deep Dive. Today we are wrestling with really the biggest question in technology and finance right now. Is the AI boom the foundational transformative breakthrough we've been universally promised? Or are we watching a spectacularly expensive repeat of the dot-com bubble, just, on a much bigger balance sheet this time?
It really is the question defining the current market, isn't it? The tension is incredibly sharp. I mean, on one side, you see enterprises committing truly staggering capital expenditure. We're talking over $1.1 trillion planned
Hmm.
just between 2026 and 2029 alone. That is just a historic level of commitment.
Wow, and yet, on the other side, the revenue, the actual money coming in for that investment, it's lagging staggeringly behind the cost of building all that infrastructure. It's this weird paradox of like massive conviction versus the current cash flow reality.
Exactly.
So our mission today is really to unpack that specific financial tension because it feels like that dictates who survives this thing and who doesn't.
And that tension, it's fundamentally summarized by what we call the AI sector's profitability J-curve. Look, we are certainly at an inflection point that is anchored in real technology, which, immediately distinguishes it from some of the vaporware of the late 90s.
Okay, so it's not just hype.
No, but it carries undeniable echoes of risk precisely because the build-out is happening, maybe a decade faster than the monetization is catching up.
Before we really dive into that risk, can you quickly explain what that J-curve fundamentally implies, especially in this capital expenditure context?
Sure. Simply put, the J-curve means massive immediate losses up front. You spend, spend, spend. And that's followed by potentially a decade or more of slow revenue acceleration, which finally, hopefully, leads to profitability. If you picture it on a graph, it looks like the letter JIA, steep dip way down into negative territory, followed by a very slow, gradual climb back up toward black ink.
And where are we on that curve right now?
We are currently right at the bottom of that dip. Costs are maximal, returns are minimal. That's the crux of it.
All right, let's start with why we should even believe that climb, that ascent, will happen at all. What's the foundation? What proves this isn't just another speculative bubble built purely on hype?
Well, the first clue is just the sheer market scale. This isn't some marginal growth story. We're looking at the global AI market growing from roughly, say, $244 billion next year, 2025, to a projected $1.7 trillion by 2033.
Okay, wait, say that again. $244 billion.
$1.7 trillion, that's over a 600% expansion projected over the next, 8, 9 years. It's genuinely explosive growth.
And crucially, you're saying this boom is anchored in real companies actually using it, right? Not just early stage consumer excitement or something.
Yeah.
What does the data show about businesses putting AI to work?
Yeah, the anchor seems pretty solid there. The data we're seeing shows that 78% of organizations now use AI in at least one business function. So it's already operational, filtering through the economy.
78%. Okay.
And maybe even more compelling, of those companies that are pursuing more advanced AI initiatives, 74% report they are meeting or even exceeding their desired return on investment targets.
Ah, see, that's significant. That level of confirmed ROI, even if it's among the early adopters, it proves the value creation isn't just theoretical, right?
What are some of the most compelling, measurable productivity gains you've seen out there?
Well, we're seeing specific concrete value that's hard to ignore. In certain knowledge workflows, office-based stuff, we're seeing productivity jumps in the range of 30 to 50%.
30 to 50. That's huge for efficiency, for margins.
It's monumental. And beyond the desk, look at manufacturing. They're using predictive maintenance models, AI, figuring out when a machine might break before it does. That's reducing machine downtime by an average of 23%.
Cutting downtime by almost a quarter? Yeah, that's a hard bottom line saving. You can bank that. Absolutely. Or think about retail. Personalization engines, right? Driven by AI. They're lifting conversion rates by 15% or more, especially during crucial sales periods. And in financial services, my goodness, AI is processing millions of transactions per second for fraud detection. It prevents losses that previously relied on slow, expensive human checks. These applications are creating real operational value right now.
It does sound like some sectors have maybe jumped ahead faster than others in really internalizing this.
They definitely have. While adoption is picking up speed broadly, healthcare seems to be leading the charge. It's showing a massive 36.8% compound annual growth rate.
Wow, healthcare. Why so fast there?
Well, it's driven largely by breakthroughs in diagnostics, getting answers faster, more accurately from scans and things, and also transforming clinical documentation,
Hmm.
basically letting highly skilled doctors and nurses spend more time on actual patient care rather than, endless paperwork. So the potential is confirmed in these areas. The utility is proven.
Okay, that adoption data, those examples, they make a compelling case for the utility side. It's real. Yet when we shift focus from, say, productivity gains within a company to the overall balance sheets, the big picture financials, we hit that contradiction again. What macro factors allowed companies to justify this massive, almost, well, it feels reckless sometimes, this shift in investment right now?
Yeah, it really was a kind of perfect storm, wasn't it? Four big structural tailwinds all lined up. First, you had the maturation of cloud computing. Companies could suddenly lease massive compute power instead of building their own incredibly expensive proprietary data centers. That was huge.
Right, renting versus owning the factory.
Exactly. Second, the data explosion. All the information pouring in from IoT devices, smartphones, digital transactions. It finally provided the vast, high-quality raw material these AI models need to learn.
And then the hardware finally caught up, allowing them to actually process all that data efficiently.
Precisely. That's the third factor. The semiconductor advances. I mean, NVIDIA's dominance here is clear, right? With the chips like the H100 and now Blackwell, they provided the specific scaled-up processing power needed. And fourth, generative AI itself kind of proved the scaling thesis worked.
What do you mean by prove the scaling thesis?
Just the idea that throwing more compute power and more data at these big transformer models actually produces genuinely capable, useful systems. It wasn't guaranteed, but it worked. And that made the massive investment look like a much surer bet for getting better performance.
And we absolutely have to point out the huge difference between this era and the dot-com boom. The actual financial health, the balance sheets of the companies making these enormous bets.
Oh, that is critical. You're right. The companies funding this build-out are not those hollowed-out internet startups from the late 90s running on fumes and hope. The major U.S. tech giants, the Big Five, they have fortress balance sheets. Collectively, they're holding well over $600 billion in cash.
600 billion. Just sitting there.
Pretty much. And they are funding this huge capital expenditure push, which, by the way, has doubled their CapEx intensity as a percentage of revenue over just the last 5 years. They're funding it largely from their own cash flow. They're not just relying on speculative stock offerings or loading up on debt like back in the day.
Okay, but even if they're using their own cash, that spending still has to ultimately lead back to that central question of ROI, right? Return on investment. Where does this financial tension really become like a critical crisis point?
It becomes a crisis point because the money being poured in is just orders of magnitude larger than the money coming out right now. Think about this. Cumulative CapEx spending is expected to eclipse $4 trillion by 2030.
4 trillion with a T.
With the T, $4 trillion fueling these global AI factories, these massive data centers. That is a level of capital commitment you usually only see for huge geopolitical infrastructure projects. Roads, bridges, energy grids.
That number almost loses meaning. It's so big. What does that historically high CapEx intensity tell us about the conviction level of these tech leaders?
It tells us they view AI as the next fundamental utility, like electricity or the internet itself, essential for survival. And they feel they absolutely must build capacity now, basically, regardless of the immediate cost or return. It's an arms race.
Okay, but let's look at the other side of the ledger then, the revenue side.
Right, and that's where the problem sharpens. Cumulative AI-generated revenue, the money actually made from AI services and products, is expected to reach only about $2 trillion in that exact same time frame, out to 2030.
Okay, hold on. So 4 trillion going out in spending, only 2 trillion projected to come back in revenue over the next 6 years or so. That leaves a monumental $2 trillion gap.
Correct. A $2 trillion hole between spending and earning in the medium term. And the direct implication of that huge long-tail funding overhang is that the major AI factory operators, the companies actually building the physical infrastructure, they might not achieve financial break-even until maybe 2032 or 2033.
So this entire investment is basically predicated on a decade-long slog just to get back to zero. Not even profit, just break-even.
For the infrastructure builders, largely yes. It's not a quick flip. It's a long, patient game based on eventual massive scale.
Wow. Okay, that decade-long financial horizon stands in really stark contrast to how the market is valuing these companies right now. This whole AI investment thesis has concentrated the market to a historic degree, hasn't it? Tech stocks now make up, what, 36% of the S&P 500?
Yep, 36%. A concentration level we haven't seen since the absolute peak of the dot-com era.
And those stocks directly exposed to AI, they command this phenomenal premium, implying basically zero room for error in execution. You look at NVIDIA, trading at around a 55x trailing price-to-earnings ratio. Broadcom, crucial for networking, is trading at over 89x PE. And these are multiples way, way above the S&P 500 average of around 23x.
They absolutely reflect a complete certainty, or at least a very strong bet, about who the winners of this infrastructure race are going to be. The market thinks it knows.
But then you contrast that kind of premium with a company like Alphabet, Google's parent. I mean, they're an AI pioneer, deep research investment for years. Yet they traded a much more reasonable, maybe 27.5x forward PE. What does that tell you?
Well, it tells you the market is still skeptical, right, about how quickly Alphabet can truly monetize its AI investments within its existing business model, specifically how they make new money from AI outside of their core advertising cash cow.
That divergence really highlights where the perceived risk is priced in.
Okay, but let's go back to that revenue lag again, because that seems like the real operational problem on the ground. If AI is supposedly so transformational, why are we hearing reports that maybe 95% of the money spent by enterprises on generative AI specifically is currently generating zero return? 95%. Yeah, that number is staggering.
Yeah.
And this is the critical execution challenge. It's what some are calling pilot purgatory. Companies are pouring billions, maybe 30 to 40 billion dollars collectively in enterprise investment into generative AI tools, yet you see this near universal initial failure rate, that 95% zero return figure. It basically shows the technology is getting stuck at the testing phase. They can't scale it out effectively.
95% failure, though. That suggests the problem is almost existential for these projects. If the tech basically works, is this really just an execution problem? Or is the tech still too immature for broad enterprise use?
I think the consensus building is that it's primarily an execution problem, and specifically it's organizational. Companies are treating AI too often as just a technology layer you slap on top of existing stuff, not as a catalyst for a complete business redesign.
Can you give an example of that?
Sure. Think about layering a really sophisticated cutting-edge chatbot onto a totally legacy customer service workflow. If you don't fundamentally restructure the underlying processes, the human roles involved, the internal data flow, the chatbot might be impressive in demos, but it doesn't actually fix the core issues or deliver scaled value.
So if you don't redesign the whole workflow around the AI just becomes like an incredibly expensive layer of paint on a crumbling wall. Is that fair?
That's a pretty good analogy, actually. Precisely. It demonstrates capability, sure, but it doesn't drive measurable, scaled business outcomes that justify the cost. And here's another kicker. Even when initiatives are eventually successful, the market seems to be pricing AI as if it's a, 7-month payback investment, like typical software. But the reality we're seeing is much longer. Most companies reporting satisfactory ROI say it took them 2 to 4 years to achieve it.
2 to 4 years. That requires a whole different level of patience and strategic commitment compared to typical tech rollouts.
Exactly. Much more patience than the market seems to have right now.
Okay, let's pull back a bit and try to recap the overall investment case here. Starting with the bullish outlook, the positive story.
Yeah.
The whole thesis rests entirely on that productivity acceleration we talked about earlier. The idea that this decade-long funding overhang will eventually pay off and pay off exponentially.
Right. And we do have some proof points that seem to affirm this possibility. You look at JP Morgan Chase, for instance. Their massive annual tech investment, much of it now AI-focused, is reportedly generating something like $1 to $1.5 billion in tangible annual value for them. AI is playing a direct role there. And those retail conversion lifts, the manufacturing efficiency gains we mentioned, they confirm the potential is absolutely real.
Okay, but then the bearish risks tied directly to that long-tail funding overhang. They are structural, and they feel very real, too.
Oh, they are, absolutely. First, you have that non-hypothetical, very real $2 trillion cumulative capex gap looming by 2030. That creates immense pressure. Second, you have massive concentration risk in the market. When, 30% of recent S&P 500 gains came from just 5 companies? If one of those tech giants stumbles, the whole market feels it intensely.
Yeah, very fragile in that sense.
And finally, you can't ignore the escalating regulatory risk. The EU AI Act is already imposing complex, costly compliance burdens. And here in the U.S., antitrust scrutiny of the mega-cap tech giants that are leading this charge is only increasing. That adds another layer of uncertainty.
So given all that, how does an investor possibly navigate this minefield? What separates the eventual winners from the companies that might get stuck in that J-curve dip indefinitely?
Yeah, investor selectivity becomes absolutely crucial here. The winners, the ones who are likely to monetize this investment wave relatively quickly and successfully, will probably combine three key characteristics. First, they'll likely have dominant market share in some critical piece of the infrastructure. They're the inescapable toll taker, like NVIDIA has been with GPUs.
Okay, infrastructure dominance. What else?
Second, they need a proven, immediate ability to monetize AI within their existing business ecosystem. Think Microsoft integrating Copilot across its entire enterprise software suite. They already have the customers and the channels.
Right, leveraging their existing footprint.
Exactly. And third, perhaps most importantly, given the costs, they absolutely must have those fortress balance sheets we talked about. They need the financial strength to sustain this multi-year, incredibly heavy CapEx investment cycle without undue financial stress or needing to constantly tap markets.
Okay, so infrastructure dominance, proven monetization path, and deep pockets. But if that break-even point, for many, is still years away, maybe 2032 or later, is there a critical deadline the market will enforce? Like a moment when patience just officially runs out and that funding overhang becomes intolerable?
Oh, absolutely. There's definitely a window. The excuse of, oh, we're just in the early stage build-out phase, that's finite. I think by late 2026, maybe early 2027, investors are going to demand proof, real proof. They will start requiring that those massive multi-billion-dollar quarterly CapEx numbers are actually generating monetizable revenue growth that significantly accelerates that payoff curve.
And if that revenue growth continues to lag projections through, say, late 2026?
If it does, then I think you should expect a pretty violent repricing across the entire sector. The market's patience will snap.
Okay, so wrapping this up, what does this all mean for you, the listener? Our conclusion seems to be that the AI revolution is undeniably real. It's anchored in proven productivity gains, real use cases. But, and this is the crucial part, it is currently being priced into the stock market almost like an overnight success story, when the financial reality, especially for the big infrastructure players, looks much more like a decade-long, multi-trillion-dollar slog just to reach profitability. So this really demands that investors hold both patience and a healthy dose of skepticism in equal measure right now.
I think that's exactly right. And if we just connect back one last time to that staggering 95% failure rate in initial generative AI adoption projects, it really suggests the real constraint here might not actually be compute power or even the trillions being poured into CapEx.
What is it then?
It might be the human and organizational side. The real barrier to watch, I think, over the next few years won't just be technology roadmaps. It'll be organizational capability. Is there a shortage of skilled practitioners, of leaders who are capable of truly redesigning core business workflows to successfully leverage the AI they've already bought? That, I suspect, is the secret choke point, the hidden variable.
That organizational capability, the ability to actually implement and adapt, that's the crucial metric to watch going forward.
That's where the value gets unlocked or not.
See you all in the next Pro Ticker Deep Dive.